Are we sitting right smack in the middle of the largest financial bubble in human history? That's the fascinating and honestly kind of terrifying theory we're unpacking in today's explainer. We're not talking about some tiny niche sector or a passing fad here. We are talking about a massive market-wide event centered around the single most transformative technology of our generation. And look, this claim isn't coming from some random internet doom scroller. This is Jeremy Grantham. Speaking in June 2026, he stated point blank, "This is, I think, the biggest investment bubble in American history." When a market legend speaks with that kind of absolute clarity, we really have to pay attention. We've got to ask ourselves why a legendary historian sees a catastrophe coming, right when the rest of the world sees endless innovation. Okay, let's dive into this because context is absolutely crucial here. Grantham is not a perpetual pessimist. He's a highly calculated market historian who accurately called the 2000.com crash. And then he did it again by predicting the 2008 financial crisis. The guy knows exactly what a systemic breaking point looks like. And right now, he's warning of a potential 70% decline in today's AI high flyers. So that brings us to the million-dollar question. Are we actually inside the biggest bubble in history? Or is the market just logically pricing in the infinite potential of artificial intelligence? To figure this out, we aren't just going to take Grantham's word for it. We're going to look strictly at the independent 2026 market data, the macroeconomic indicators, and corporate spending habits to see if the hard numbers actually back up this terrifying warning. Section 1. Great ideas, not scams. So the crucial point is, before we even look at those numbers, we need to completely rethink what a bubble actually is. Because the biggest misconception out there is that bubbles are built on scams or lies. Actually, it's quite the opposite. Grantham points out that the greatest bubbles in history always form around the most important world-changing ideas. Think about railroads in the 19th century, or the internet in the 90s. Everyone knew they were going to change the world, so everyone threw their money in. That leads to a massive, massive overinvestment. AI is exactly that, a defining, world-changing great idea. And ironically, that's exactly why it fits the perfect profile of a historic bubble. Just look at the trajectory of Amazon as the ultimate historical precedent here. Back in 1999, everyone knew the internet was the future, and Amazon's stock went up, 6 or 7 times? And you know what? They were completely right about the tech. But when the 2001 tech crash hit, Amazon's stock plummeted by 92%. It was absolutely devastated. It was only out of that wreckage that it eventually rose up to inherit the retail world. Grantham's rule is brilliantly simple. The greater the idea, the more obvious it is, the more money floods in, and the bigger the resulting bust. Section 2. The data behind the warning. All right, so that's the historical narrative. But what happens when we crack open the hard, independent 2026 data? Let's start with arguably the most trusted valuation metric out there, the Shiller CAPE ratio. This basically measures how expensive stocks are compared to their actual profits over a decade. Now, historically, the long-term average for this ratio sits right around 16 to 17. But as of June 2026, the S&P 500's CAPE ratio is hovering near 40. To put that into perspective, at this extreme level, the math literally dictates that the implied future real return for investors is roughly just 1.7% a year. The market is basically priced for a perfection that mathematically cannot be sustained. Then we have the famous Buffett Indicator, which takes the total U.S. market cap and divides it by the national GDP, basically the total size of the economy. Now, Warren Buffett has historically said that a level of 120% means the market is getting overvalued. Right now, as we speak, that indicator sits at an astonishing 235%. That's literally a fraction of a percent away from its all-time historical record. And this brilliantly illustrates exactly where all that money is sitting. The S&P 500 isn't really a diverse group of 500 companies anymore. The top 10 largest U.S. stocks now make up a record 41% of the entire index. AI-linked megacaps are roughly 40 to 45% of the index's total value. We haven't seen a single theme concentration this high since the peak right before the 1929 crash. NVIDIA alone carries a weight above 8%. Independent analysts are flat out saying that buying the index today is basically making a singular directional bet on artificial intelligence. To keep that whole narrative going, big tech spending has just become staggering. We're talking capital expenditure for AI infrastructure jumping from $400 billion in 2025 to a projected $725 billion in 2026. Amazon is guiding toward $200 billion, Microsoft around $150 billion, Meta up to $145 billion. Grantham actually joked about this whole "my capex is bigger than your capex" mindset. But the reality? It's pretty sobering. These companies have started borrowing heavily, piling debt on top of their cash flows, literally just to fund this frantic AI build-out. Now, to be fair, smart, credible people do disagree on the exact timing here, and some argue that AI's eventual productivity gains are going to justify these massive prices. But man, other respected skeptics are raising some massive systemic red flags. Michael Burry, the guy famous for predicting 2008, he notes that a whopping 87% of venture capital funding now flows straight to AI. For context, in 1999, internet companies captured less than 40% of VC money. On top of that, an MIT study recently found that roughly 95% of corporate generative AI pilots delivered zero measurable financial return. None. And then you have analysts pointing to circular financing. This is where money is just looping. NVIDIA invests in CoreWeave buys NVIDIA chips, while an unprofitable OpenAI also holds stake. The money is literally just doing laps between a handful of the same players.
Section 3. How bad it could get. So when you take those crazy macroeconomic red flags and apply them to history, you really have to ask, if this bubble pops, how bad could it actually get? Well, history is pretty clinical about what comes next. In the 2000 dot-com crash, the Nasdaq fell between 78% and 82%, and it took 15 long years to recover. The 1929 crash, that's on 80+% decline and kicked off the Great Depression. But maybe the most chilling comparison is the Japanese Nikkei in 1989. At its absolute peak, the Japanese market reached 65 times earnings. The US market in the 2000 tech bubble, it hit 35. Today, the US sits between 35 and 40. When Japan's bubble burst, it dropped for 2 decades. It took 34 years from December 1989 all the way to February 2024 just to reclaim that previous high. Think about that.
Now, what's really interesting about this historical context is how it completely changes the way you view Grantham's warning. He stated that a 70% decline in today's AI high flyers would not be unexpected. Without the context, 70% sounds like some apocalyptic outlier, right? But looking at the cold, hard data, it's actually the standard historical norm for a bubble of this magnitude.
Section 4. What it means for you.
So bringing all this huge macroeconomic data down to the micro level, what does this actually mean for you, the ordinary retail investor? Well, Grantham's actionable advice to avoid the blast zone is surprisingly straightforward. His number one rule, do not be all in on US stocks. If you're sitting on a massive position in US tech stocks right now, his personal advice is to seriously consider selling. Instead, you need to aggressively diversify. Look at non-US equities, add in some bonds, maybe even hold a little in precious metals. But he gives a really crucial warning here. You are probably never going to hear this advice from a traditional investment advisor. Why? Because pulling you out of popular US tech stocks and having you sit on the sidelines, well, that loses them a whole lot of business. And here's the tough truth. As Grantham notes, we humans just have an enormous predisposition to optimism. We're practically hardwired to search for good news and run away from unpleasantness. I mean, the only people who truly think you can have compound, infinite growth on a finite planet are madmen and economists, right? The thing is, bubbles aren't invisible. They're entirely visible if you're just willing to detach from the hype and look at the math. But you've got to do it yourself, because structurally speaking, no help is coming from Wall Street. And that is the ultimate takeaway of this explainer. The independent gauges, the CAPE ratio, the Buffett Indicator, this completely unprecedented index concentration, and those eye-watering capital expenditures, they all sit at historic extremes.
Look, AI might very well change the entire world over the next 20 years, exactly like the internet did. But as the numbers clearly show, that doesn't mean today's market valuations are tethered to reality. The data is sitting right there in front of us. So the only question left is, will you take control of your financial education and look at it before the bubble bursts